Good morning and happy Friday, all you wonderful melon heads out there. Today is May 26th, 2023. Top story this morning is sticky inflation. I use the air quotes. Why am I using air quotes when I say sticky inflation? Because I don't think inflation is really all that sticky. I'm skeptical this morning. The market is seeing this. PCE came in, personal consumption expenditures. That's the Federal Reserve's favorite measure of inflation. Why? Because it usually comes in lower than CPI. I guess that's why it's their favorite. They're always looking to understate inflation. That came in higher than expected today. Headline PCE came in at 4.4%. Core PCE came in at 4.7%. Now that's why they're saying sticky, because core, which strips out volatile food and energy, was higher. Remember last year, headline inflation was always much higher than core inflation. And that's when the Federal Reserve and everybody would say, oh, inflation is because Putin, inflation is because COVID. Well, now that core is higher than headline, it's hard to blame your inflation problems on Vladimir Putin when it's not food and it's not energy driving the inflation. So core inflation is now higher than headline inflation. That's why people are saying it's sticky. Consumers are getting used to higher prices. They're paying them, and we've got some spending data along with this that supports that. But the thing is, inflation is still coming down. This is really just a bump in a chart that's in free fall. I'm going to show you that. And the reason why I'm driving so much and why I'm focusing this morning on the fact that the market is getting this one wrong is because the odds of a Fed rate hike, according to the CME Group's interest rate futures contract, are now approaching 60%, which means the Fed is probably going to hike rates in June now. This will be a colossal mistake. Remember, we have got banks are failing because of unrealized losses on bonds and loans and commercial real estate. All losses being driven by higher interest rates. And we know that the effects of the interest rate hikes have a lag, anywhere from 12 months to 18 months, which means all this Silicon Valley Bank, First Republic, Signature Bank, Silvergate Bank, Credit Suisse, all of these banks that are failing or having trouble, these are failing because of the first few rate hikes last year. And, we've got 4 consecutive 75 basis point rate hikes from last summer that have still not seen their first birthday, which means the economy is not yet feeling the effects of those rate hikes. And we've already got the second, third, and fourth largest bank failures in U.S. history. So, oh my goodness, we got 4.4% headline PCE inflation. Let's tack another Fed rate hike on top of the rate hikes that have already gone too far, according to what the banking system is telling us. And that's why I think the market is getting the signals wrong right now. I think this is just a bump in the inflation chart as it heads much, much lower because, folks, deflation is coming. We're already seeing deflation in the money supply. The money supply is shrinking. Soon we're going to see deflation in asset prices, stocks, bonds, homes, you name it. Once that hits, then we see deflation in consumer prices. All right, with that, we are going to shrink my big melon of a head, and let's see what's going on in markets. Well, we got another Fed rate hike coming. Nobody cares. Number go up. Stocks only ever go up, of course. 4,163 in the S&P this morning, up another 13.5 points or 0.33%. We've got the Dow Jones is up 63 points or 0.19% at 32,827 this morning. And the NASDAQ is up 0.4% or 53 points, 12,751. Stocks only ever go up, folks. It doesn't matter how bad the economy gets, number go up. The DXY right now is down a little bit. It was down a lot more before that PCE report came out. Here is when the PCE report came out, and you can see the dollar started rallying on that news. That is the market starting to price in a more aggressive Fed. Currently at 104.18, down just 6 basis points now. It was down about 20 basis points earlier today. Looking over at the bond market, we've got the yields in the 1-month Treasury are moving a little bit higher this morning at 5.76, up almost 10 basis points. The 10-year Treasury is at 3.84, up 3 basis points. And the 2-year is up 8 basis points or 4.58. Something I want to draw your attention to. I talk about U.S. bonds all the time. Let's scroll up just a little bit because I want to point your attention to the UK 10-year gilt. Check this one out. This is the UK's 10-year bond. They call it the gilt over there. It's at 4.4% right now. And let me just Real quick, open up a chart of the UK 10-year gilt. I'm doing this one on the fly. I wasn't planning on bringing this chart up. But let's look at, say, a 1-year chart of this. And do you guys see why I'm worried about the UK 10-year gilt right now? Do you guys remember what happened back here, back in October of last year, when yields on the 10-year gilt were around this level? That's when the UK pension system almost blew up in their faces. Now, the Bank of England stepped in very abruptly in October of last year, and they started buying gilts, basically buying all of these troubled assets from the pension system to try to relieve the pressure. A lot of it had to do with liability-driven investments and the way they were hedging their interest rate risk in the pension system. I did a video on that months ago. I hope they took advantage of that bailout that they got from the Bank of England, the non-bailout bailout. I mean, this was the crisis that torpedoed Liz Truss's government, if you remember. Well, now yields on the UK 10-year gilt are right back where they were when the UK pension system blew up. I hope those pension guys took care of their problems when they had the chance. Otherwise, we'll be hearing about it very soon. Interest rates on those UK bonds are on the rise rapidly. Looking over at commodities right now, we've got gold is up $2 this morning at 1946. Silver is up 36% at 36 cents. Sorry to get you excited there, silver bugs. At 23.27. Metals are liking the slightly weaker dollar this morning. We got WTI crude is up about $1 at 72.81, and natural gas is at 2.39, down about 8 cents. Not a whole lot of movement in commodities this morning, but check this one out. This is the main story. Inflation rose 0.4% for the month in April and 4.7% from a year ago, according to key gauge for the Fed. Interesting nitpick here. CNBC right now, they're saying 4.7% in the headline, all right? This is a little deceiving because 4.7% was the core inflation number. That's when you strip out food and energy. But in the headline here, they're not telling you that core PCE was 4.7. They're kind of suggesting that the headline number was 4.7. It was 4.4. Maybe that's an oversight, but I always like to just kind of dig in a little bit to the way the traditional financial press is presenting the data, because right now they're kind of misleading to make it seem like inflation is higher than it really is. It's curious to see them doing that. Inflation stayed stubbornly high in April, potentially reinforcing the chances that interest rates could stay higher for longer, according to a gauge released Friday that the Federal Reserve follows closely. The Personal Consumption Expenditures Price Index, which measures a variety of goods and services and adjusts for changes in consumer behavior, rose 0.4% for the month, excluding food and energy, higher than the 0.3 estimate. On an annual basis, the gauge increased 4.7%. Again, that's the core number. That's not the headline number, and they're not saying that. 0.1 percentage points higher than expected, the Commerce Department had reported. Now they get into it. Now we're 4 paragraphs down, and now they clarify. If you include food and energy, headline PCE also rose 0.4% and was up 4.4% from a year ago, higher than the 4.2% rate in March. So why are they waiting until the 4th paragraph down to give you the headline number? Why are they presenting the core number as if it was the headline number? I found that a little interesting to see CNBC presenting the data in this way right now. I'm not going to make any conspiracy allegations or anything. It's just curious to see them doing that. I've never seen them do that before. Now, here's something that I'm zeroing in on. Again, you got to scroll down to get to this. The report showed that spending increased 0.8% for the month, while personal income accelerated 0.4%. Both numbers were expected to be up by 0.4%. All right, so 2 things I want to point out here. First of all, this is the first month that I've seen in a long time where personal income rose at the same rate as inflation. I have not seen that in years. So that, in my opinion, that is very good news to see. At the very least, for 1 month, we all stopped getting a little bit poorer for just a month. Oh, that was nice, wasn't it? Wow. But however, our spending went up twice as much. Spending increased 0.8%, even though income only went up 0.4%, which means we went further into debt at a time when interest rates are still rising, and they're probably going to rise even more. This is one of the reasons why I am perma-bear. I wear it on my sleeve. Jack is a perma-bear. I get it. I'm always negative. But when I see debt levels rising faster than income, yeah, that's a problem for me. That is not sustainable. Something's going to break if you keep that up. And we've been keeping that up for what? Oh, I don't know, 50 years now. All right, let's move on. Now, why am I saying this trend is not so worrying? Why am I saying the market is getting the wrong signal here? Well, this isn't trading economics where they plot the data point. Here's the headline number, the 4.4 number, right? So, okay, it came in higher than expected. I get it. And it's up versus last month. But does this look like a rising trend to you? Does this look like a inflation is on the rise? It's not what I see. I see inflation is falling incredibly rapidly. Okay, it bounced, but look at the step change down we had last month. Look at what happened between February and March. And now we uptick by a little bit, and everybody's like, oh my God, sticky high inflation. It's rising. More rate hikes. Quick, Jerome Powell, get more aggressive. No, that is the wrong answer, guys. Again, 4 consecutive 75 basis point rate hikes from last year that have still not seen their first birthday. Maybe we just sit back and wait to see what happens. All right, because the first few rate hikes have already failed banks. Maybe we wait and see before we go take more drastic action. You know what? Forget it. It's the Fed. They just play games with people's lives. Poke the economy with a stick and let's see what happens. Why not? Now, if you zoom out on this chart, check out the 5-year chart of this. Again, does this look like a gauge of inflation that's in decline to you? Everybody's in the press, CNBC. Oh my God, sticky inflation, more aggressive Fed. Look, this little uptick here. That's what we're talking about. Look at the downtrend. Look at how PCE has come down since last summer. And everybody's freaking out over this little blip in the data point. Guys, inflation is still falling. Deflation is coming. Whether you like it or not, some people, depending on your definition, you could argue it's already here because the money supply is falling. The latest number for M2 was down 4.6% year over year. That is the fastest decline in money supply since 1930. And the market, well, check this one out. Right now, the market is pricing in a 58.5% chance of another rate hike in June. It's now a strong probability. It's not just a possibility anymore. Now according to interest rate futures, they're probably going to hike rates in a couple of days here. Guys, banks are failing, and they've now hiked rates twice already after banks started failing, and now we're sitting here talking about a third rate hike in the midst of a banking crisis. Guys, what are we doing? Right? The last time I felt this way was probably late spring, early summer 2020 when we were printing trillions of dollars, and I was sitting there just screaming to us, guys, what are we doing here? We know what's going to happen here if we keep doing this. We're going to get high inflation. Oh, no, it's transitory. Don't worry. It's just because of Putin. Well, it wasn't transitory, was it? And now I'm sitting here in disbelief saying, how could we possibly be talking about another rate hike for the third time since banks started failing? We know what's going to happen. Let's not keep doing the same thing expecting a different result. And yet here we go, June, 58.5% likelihood of another rate hike in June. And oh, wait, there's more. There's now a 26% likelihood of 2 rate hikes between now and July. There's people starting to say we're going to hike 2 more times. Okay, good luck with that. Have fun, everybody. All right, moving on. Let's talk about the debt ceiling really quick. We've got the Treasury General Account is now down to $49.4 billion. That is down from 70-something yesterday. Why is this alarming? Well, at the beginning of the month in June, you've got government payroll, right? People get paid early in the month. So the government is about to write big checks in a couple of days. They're down to almost nothing. Oh, and we're heading into a 3-day weekend. Congress, I'm pretty sure Congress already left for the holiday. Go figure, Congress. Would Congress ever give up a day off? Silly rabbit. No, Congress doesn't give up their day off. They're already long gone. I'm sure they'll call it a fact-finding mission. They'll figure out some way to get the taxpayers to pay for their trip to Cancun or wherever they're going over the weekend. But we're running out of time here, folks. Now, there's encouraging signs. There's a lot of optimism being talked about right now. Potential debt ceiling deal starts to take place as deadline looms. I got a couple of notes here. I'm not going to read all the way through this article, but it looks like we're settling in somewhere on a $100 billion cut in spending. La-di-da, $100 billion. Give Congress a week for some crisis. Oh my God, there was a thunderstorm in Alabama. Here's a $100 billion aid package, and everything we've been talking about for the last month goes up in smoke. Trust me, that will happen. But we're settling somewhere around a $100 billion cut. spending caps for 2 years. Now, spending caps, that term is a little deceptive because a spending cap is not a spending cut. A spending cap is actually a spending increase, but they're capping the increase. They're saying we're going to increase spending by less. We're calling it a cap, and we're presenting it as a cut. It's still more spending. All right. So isn't that lovely? Some of the sticking points. There's three topics I can see that it looks like they're still arguing back and forth. First of all, is increases in defense spending. All right. Both sides are saying increases in defense spending. The Democrats want smaller increases in defense spending. The Republicans want bigger increases in defense spending. Look, guys, we already spend more money on defense than the next 8 or 9 largest militaries in the world combined, 7 of which are allies. Maybe we could increase. I think this is an easy win for everybody here. Republicans, give it to them, right? We're still spending trillions, quadrillions on defense. Give it to them. Another sticking point is working requirements for able-bodied adults with no kids. Guys, if you're going to get free money, if society is going to contribute to you and you're an able-bodied adult with no dependents depending on you, you can afford to contribute a little bit to society. Work requirements for able-bodied adults with no kids in order to receive government benefits. Again, I think that's a no-brainer. Another one, which I found kind of interesting, is they're talking about clawing back $80 billion of new funding for the IRS. Whoa. I can hear the applause coming through the interwebs, through my camera. All right, pipe down, everybody. Pipe down, everybody. Yep, it looks like that one is on the table. Remember the 87,000 new IRS agents that they were going to hire that were going to come after everybody? Well, it looks like it's on the table about cutting funding for that, which was part of the laughably titled Inflation Reduction Act from last year. So that is one of the sticking points. Republicans want that money clawed back. Democrats don't. Also on the table is clawback of unspent COVID funds. That one is probably going to happen. Now, there's one interesting thing in this article that I wanted to point out to you guys. Scrolling down a little bit here, I found this paragraph. It's about halfway down this article. I found this one interesting. On Wall Street, investors are setting plans to increase the likelihood that they would be able to keep trading all U.S. Treasuries, even those with past due interest or principal payments, in the event of a default. The Securities Industry and Financial Markets Association Trade Group is hoping to limit confusion by organizing a series of conference calls that would take place if a default looked imminent. So, guys, what they're saying here is that the bankers and the big investment firms are getting together and they're saying, look, even if the X date comes, even if we break the debt ceiling and the government defaults, we think we can still keep trading these IOUs from the government as if they were as good as cash, because eventually the government will get their act together and they'll repay that debt. So this is kind of suggesting maybe it won't be the financial Armageddon they're advertising. It may not be fun, but seems like they've got a backup plan for if we break the debt ceiling. So, as my moderator Mish put it on the phone call, maybe we do default. And maybe they come up with this backup plan and it's not the end of the world. Well, then what happens? Now this stupid fear porn that we go through every couple of years, it's no longer on the table. Maybe we stop spending so much money and it's not the end of the world. I just throw them out there. Anyways, it looks like they've got a plan for that. Another story I saw come up yesterday, social credit scores, folks. Here they come. New York City Commission votes to halt deposits at Capital One. Also missing from the title is KeyBank. This one, shout out to my man Chris Taylor over at Financial Prepper. He was on top of this one yesterday. The New York City Banking Commission voted to halt deposits into the city's bank accounts at Capital One and KeyBank after the lenders failed to submit plans on their efforts to root out discrimination. City Comptroller Brad Lander joined Mayor Eric Adams and the Department of Finance to announce that the city would stop making deposits into the two banks, Lander said in a statement on Thursday. The existing accounts will be used to make payments, but no additional deposits will be made, nor will accounts be opened at either bank, according to a spokesman for the controller. Capital One prohibits discrimination and harassment against any applicant, intern, associate vendor, contractor, customer, or client on the basis of protected characteristics, the bank said in a statement after the controller's announcement. So, New York City, the commissar over in New York City got together and said every bank needs to submit their detailed plan for ESG, for DEI, for all the letter word salad, all the alphabet people, as Dave Chappelle would say it. We need a detailed plan for how you are going to root out discrimination against protected people. And I guess they didn't like the answer from Capital One. They didn't like the answer from KeyBank. And so New York City is saying your social credit score is now not good enough. The city will not do business with you anymore. We're not going to send any more deposits to your banks. Social credit scores, folks, they're trying to force these banks to comply with their social ideology. And if the banks don't play ball, they lose the business of the city government. So that's good. It's good to know New York City is really attacking their biggest problems. Do you really think discrimination is the biggest problem in New York City right now? Maybe, besides the human excrement on the sidewalk, besides the commercial real estate crisis, besides how many gajillion square feet of unused office space are in that city, and that the tax basis of the whole city is about to go up in smoke when the commercial real estate bubble pops. But by all means, guys, go after social credit scores. Keep up the awesome work, City of New York. Guys, America's cities are in such a state of decline. I have mixed feelings on it, all right? I've never been a city guy. I don't like cities. I don't even like visiting cities, all right? But there are people that live in these places, and there are good people that live in these places, and they don't deserve what's happening to their homes. They deserve better than their leadership is giving them. But these cities are dying. These are dying places. I mean, the only thing that was keeping them alive was these financial centers and the high real estate values and the money that flows from people commuting into the cities and working there, generating revenue for the people who live there. That's going away. These cities are dying, and I don't see any way to reverse it, to be honest with you. I don't know what they're going to do. Maybe they'll surprise us, but social credit scores sure as heck is not going to solve the problems facing New York City, that's for sure. All right, moving on. We have got Europe's economic engine is breaking down. Germany is at risk of a long, slow decline with consequences for the whole of the EU. Germany officially entered a recession yesterday. Now, look, I was one of the guys who was dooming and glooming out the wazoo back in the fall about the European energy crisis. I ended up being wrong about that because Europe had a warm winter. I wasn't wrong about the economics of it. I was wrong about the meteorology of it, all right? Europe had a warm winter, and that's the only reason they avoided economic catastrophe. But they still are entering a recession because the power prices in Europe went so high. Germany shut down so much of its manufacturing base in order to save power heading into that winter, and now their economy is actually contracting. And I don't see Europe doing anything that convinces me this is going to change. All I hear from Europe is wind and solar, is price caps, is throttling industry, class warfare. I don't know how Europe is going to stop this decline, much the same way I don't know how America's cities are going to stop the decline. But Germany has been Europe's economic engine for decades, pulling the region through one crisis after another. But the resilience is breaking down, and it spells danger for the whole continent. Decades of flawed energy policy, the demise of combustion engine cars, and the sluggish transition to new technologies are converging to pose the most fundamental threat to the nation's prosperity since reunification. And look, they throw this in here, a sluggish transition to new technologies. Listen, Bloomberg, the problem in Europe's economy is not that they haven't built enough windmills and solar panels. The problem is they're acting like windmills and solar panels is this panacea golden goose that's going to save them from everything. It's not. This insistence on this insistence on solar and wind and nothing else is the problem in Europe. And they still don't get it. They're still acting like the problem is that they're not doing enough. Last few stories, guys. JP Morgan tells 1,000 First Republic employees that they'll lose their jobs. Remember, JP Morgan bought First Republic Bank. It was a very good deal for JP Morgan. It was a very bad deal for everybody else in the world. And it looks like 1,000 of the 7,000 First Republic employees are going to get laid off. And not to be outdone, First Citizens will be cutting 500 of the former Silicon Valley Bank employees. And why am I mentioning this? Because remember, folks, the missing ingredient to a housing crisis is unemployment. Home prices are not falling, at least not falling as rapidly as they probably should, because the market is frozen right now. Nobody's selling their house. Everybody's got their low mortgages that they refied during the pandemic, and they're hanging on to those. So the only people selling are people who are forced to sell. Everybody else is just not selling, and that's the only reason why prices aren't falling so fast right now, is because there's no buyers, but there's also no sellers. Well, when people lose their jobs, they become home sellers, whether they want to be or not. And there's been a lot of headlines about people losing their jobs in the first half of this year. We're seeing some more of it today. Another 1,500 people at these two failed banks are now unemployed. And, well, let's just say that is not good tidings for our housing system. And I just want to say thank you very much to Mr. Grumpa, who says, was NVIDIA's Q2 guidance unicorns and rainbows provided to manipulate their stock price? If not, where are the sales coming from for such extreme Q2 growth? We're going to know real quick, Grumpa. Let me just tell you that. Is it all unicorns and rainbows? It better not be. I tell you what, if it is, then people are going to be like indicted going to jail, because that was a massive increase in forecast. And it was not next year's earnings or next decade's earnings. It was Q2 that they were forecasting when they went from 7.2 billion to 11 billion. Those were Q2 numbers. Guys, were almost 2/3 of the way through Q2. So I'm assuming, I have to assume, that they've already seen a lot of those sales. And if they haven't, then they have 1 month left to generate those sales. And if they don't do that, they're going to have an awful lot of explaining to do. So I'm guessing that there was some truth to it. I really do think there was some truth to it. AI is happening, all right? I've used ChatGPT. It's impressive. It's useful, all right? And I'm sure NVIDIA is selling a lot of chips. I'm sure a lot of companies are making investments in AI, and NVIDIA is providing the hardware for that. So I'm sure they are seeing an increase in sales. Are they seeing an increase that big? I'm skeptical. I'm not going to outright say they're not, but I'm skeptical. Now, all of that is irrelevant, because my biggest problem with what happened with NVIDIA yesterday was the market reaction to it. The market is way overpaying for this stuff. Even if they're generating these numbers, NVIDIA is trading at over 220 times earnings. That is obscene. That is an obscene valuation. Even if that growth does manifest, it still doesn't justify the premium being paid for NVIDIA stock. And that's why I was just so blown away by what I was seeing with NVIDIA yesterday. The market, it's too much hype. People are way overpaying for it. You know, it's just like when it was a couple of years ago. Remember, was it Riot Blockchain? I can't remember what it was. Some company, it was like an iced tea company, and they changed their name to include blockchain in their company. It wasn't even a blockchain company. It was like an iced tea company, but they put blockchain in their name, and all of a sudden their PE multiple just exploded higher. Everybody started investing in the company. It was stupid blockchain hype. There was nothing behind it, and of course that didn't last. So that's kind of what I see happening with NVIDIA here. You know, NVIDIA is they just quickly pivot to whatever fad is fashionable at that moment, and maybe they make money, maybe they don't. It doesn't matter. People are paying too much for the stock. That's my take on NVIDIA. Thank you very much, Grandpa, for the super chat and the support of the channel. I appreciate that very much. And thank you, Mark Fragola, for the super chat. He says, if the debt ceiling is raised, it will be a good time to yell, damn it. Dang it, Janet. Dang it, Janet. That might be a good time to say that. Now, listen, if the debt ceiling is raised, let me just thank you, Mark, again for the super chat. Let me just say this. If the debt ceiling is raised, two things. We can put to bed this debt ceiling malarkey. For the love of God, can we end this discussion? I hate the debt ceiling topic. I can't stand it. I don't like the people involved in it. I don't like what it brings out in people. I don't like the discussion around it. I think it's pointless that we even have the debate. Of course, the United States has a spending problem. If the United States doesn't have a spending problem, then enjoy your unicorns and rainbows. You live in a fantasy world. All right, you are not operating within the confines of reality if you think the United States doesn't have a spending problem. All right, now the other thing about that is we can go back to worrying about the very real threat of Janet Yellen's borrowing bender. That's coming up just as soon as the debt ceiling gets raised. That's coming up soon. As soon as they raise that debt ceiling, she's going to borrow $1 trillion over the next few months. That's going to suck liquidity right out of that bond market, driving rates higher, making the dollar more scarce, sending the DXY higher. That's going to wreak havoc in our debt-based system. Mark my words, there is a liquidity crisis coming, and it's coming fast. Everybody's going to breathe a sigh of relief when the debt ceiling gets raised. It will be very short-lived. All right, guys, That's it. Thanks again, Mark Fagola and Grandpa for the super chats. Thank you to my Patreon supporters for everything you guys do for the channel. Hi, Mom. Hi, Dad. I love you guys. And until next time, live small and dream big.